Good day, everybody. Welcome to this panel discussion with some well-known, well-respected technical analysts. My name is Trevor Neal. I'll be hosting today's session. I have been a technical analyst, professional trader, institutional trader for over 40 years, starting many, many years ago at Merrill Lynch, trading coffee and cocoa and sugar, and now a fund manager and professional technical analyst. But let me introduce you to our guests. First of all, let's introduce Clive Lambert, who I've known for many years as one of the, and I know him as one of the best technical analysts, prize-winning technical analysts. But would you like to say a couple of words about yourself, Clive?
Yeah, hi Trevor. Yeah, I've been, I was a broker in the 90s on the FuturesTechs in London, and then I set up my own firm in 2000, and I've been doing that ever since. And I'm a highly commodities. With respect to saying the insult can't hear me. Correct. See if I can sort something. I think the microphone was working before. Hello, hello.
I'm really sorry, Clive, but I can't hear you.
Same here, yeah.
Yeah. I know you were talking, I could see that, but I couldn't hear you. I can hear Eddie. Perhaps as Marie sorts out the audio with Clive, perhaps Eddie, same question. Would you like to introduce yourself? And let me first of all say a comment. I've known you for many years indeed. I've watched you grow as a technical analyst into one of the foremost technical analysts in Europe or the world, if you like. But please introduce yourself.
You're very, very kind, Clive. Clive is one of the two people, along with a gentleman who's passed away, Eddie Edwards, who brought me into technical analysis. I'm forever grateful to him. He's a guru to me. My name is Eddie Tofpik. I'm head of technical analysis and senior markets analyst at ADM Investor Service International Limited, part of Archer Daniels Midland. I'm also a director of the Society of Technical Analysts in the UK, the largest and the oldest, one of the largest and the oldest such societies in the world as well.
Okay, thanks very much. Let me just check that I can hear Clive now. Clive?
Okay, I'm going to try something.
Yes, I can hear you now. Yeah.
Okay, I've put my headset on, so hopefully that fixes the issue. Right, yeah.
I think we didn't hear your introduction, so would you like to quickly do it again?
Go again, right, yeah. So yeah, 20 years of technical analyst, 10 years of broker on the live floor before that. So I'm not from a commodities background, which some of my clients like the idea of, because it means I have no silly ideas or otherwise of what the fundamental drivers might be, and just purely look at the charts. And that seems to be something that my clients like, and my client base is mainly energy, in the energy space these days. And you know, so yeah, there's probably a few people listening in who are subscribers, and yeah, that's me. And I'm also along with Eddie on the board of the Society of Technical Analysts, and obviously Trevor, you're one of the mainstay, long-standing members of that wonderful society. So yes,
absolutely.
Okay, well, let's get cracking. The subject today is where can technical analysis support trading in today's landscape? Now, we've moved into an increasingly technological landscape, and many areas of financial services have been encroached or even taken over by machines, if you like. So let me ask you the first question. With this increased use of algorithmic trading and AI analysis and so forth, is technical analysis actually still relevant? Let's start with you, Eddie.
It makes it easier. A machine can be predictable, I suppose, in many more ways than that. It's actually makes it easier, that the reactivity and the patterns that show up and the indicators that are derived from those patterns are just easier to interpret the market. Now, not all markets are still using having a great indentation of algorithmic trading, but those that are, it makes it a lot easier in some ways to actually help. I just find it's a cleaner form of data in some ways than what it was in the past.
Yes. And Clive, what's your view on that?
Well, I've seen algorithmic trading is probably relatively young in the energy space, but not so in the financial futures space. And I've been writing technical analysis for 20 years on a daily basis on financial markets as well as the energy complex. And I've got to be honest with you, I haven't changed a huge amount with respect to what I do and how I do it, despite the fact that now in financial markets, algorithmic trading accounts for well over 50% of the daily volumes. So what that suggests to me is that technical analysis is still completely relevant and not a lot has changed, and it actually fits in with algorithmic trade, fits in and around algorithmic trading, and just sort of apart from maybe some shorter term noise, it hasn't really changed much.
Yes, I mean, it's a very difficult thing to say definitively, because we've got no measurements really to say whether technical analysis is still relevant or not. You know, it's hard to be able to quantify that in any other way and answer it subjectively. We can have opinions about that. Obviously, in this room here, with the three of us doing what we do, we're definitely, we think there is a future for technical analysis and for our jobs. But
we hope so.
We hope so. But so we plug away at it. But really, I've got a question just come up here, which is a very good way of asking what I was about to ask you. If all algos use the same body of technical analysis techniques, won't they all come to the same conclusion and attempt to trade the same direction? And who will be left on the other side of the market? So, I mean, that's a very good question, really. If the machines can do what we do, then everything will be done and they'll all come to the same conclusion, the correct conclusion. But what do you think about that? Why is that not true? Why is there always a buyer and a seller? Please
I'll make a start with that if you like.
Yeah.
Every market has thousands of different participants doing thousands of different things with that market, or hundreds, or lots, and so there is never going to be one overriding form of analysis that is going to run the market, and that's what I think about technicals versus fundamentals and everything. Also, an interesting aside to that is that I've got someone else that does analysis in this space that we all know well is David Linton. David Linton uses a completely different technical analysis techniques to myself. Okay, yeah. He looks at point and figure charts and Ichimoku charts mainly for his analysis. I look at candlestick charts and market profile mainly for my analysis. So there isn't, technical analysis in itself is a wide church with different people using different techniques. Eddie loves his Andrew's pitchforks. I just use my pitchfork for the garden, right? Not for hedging the hedges, right? Yeah, but so yeah, and so that's another. But actually, quite interestingly, myself and David can quite often come up with similar targets or similar views on what the trend is and what may happen going forward.
What do you think, Eddie?
Using our different techniques.
I agree with that entirely. First off, I go back to the first point, which is something I believe very, very strongly, that technical analysis is an art, not a science. It still requires the human element to interpret what is going on there. You can do as much machine learning at the moment and AI and work on it as you can, but it cannot fully interpret what's going on in the same session that say somebody with experience has. The algos don't necessarily use the same methodology as technical analysis, and as Clive has said, it is a huge church. There are people out there who are using candlestick theory, which is going back 250 years or something like that. And then you've got ones which are using GAN, which is about 100 years old, and a lot of people don't really understand necessarily. But that and market profile, I use the medium line method, or known as pitchforks, quite a lot for general work. I also use candlesticks to a great degree on short-term stuff, because if it's been working for 250 odd years, it's still going to work whatever happens. And I also use pattern analysis as well. And all of those are interpretations of what's going on. And yes, we do come towards a general conclusion that is the truth, because you're coming in from different areas of different things, and all of them come towards the truth. Now, a market is made up of three participants: the consumer, the producer, and the speculator, the one in between. The algos have come in from the speculative side and now also into both the consumer and the producer side, and they're both using it to help them in their execution of their transactions, etc. And that's fine. There's no problem there, but it makes it cleaner in some ways. As I said earlier, it makes it cleaner data. Is better to look at, whereas before somebody might drop an order or forget it, or gone down a pub and left the ticket sitting on the side of the ring or the pit or something like that. And that's happened. I've seen that happen. But in the markets we live in now, it's cleaner information. And I think that actually helps technical analysis in its way of interpreting what's going on in the market.
Yeah, sorry. Yes, I think I agree with both of you there, and I think we should also extend. The question is, there is no simple one right answer. Is the market bullish or bearish? It's going to go up or down. One person could buy from the other, one person could buy and another could sell, and both of them could make a profit from that. One of them taking their profit a moment later, and one of them taking their profit a week later. And for them, each of them, they did different type of analysis with different horizons. So it's really, we're a sort of service industry. We're there to serve the clients and to give them the perspective, but it's their perspective that we're doing. It can be a contradiction. You and I could say different things, but we're talking to different people, and it's correct for both those people. We've got some good questions coming on to, which I'm going to come to in a minute, but let's stay with the energy and commodity markets here. And is liquidity too low not in crude oil, but in some of the energy and commodity markets for technical analysis to be efficient or work? Is there a minimum amount of liquidity that is required for technical analysis to work? I'll start with you this time, Eddie, please.
I track and follow and comment upon some very illiquid markets. EEX butter futures, London feed wheat, which goes through a seasonal patch where there's nothing going on, and then suddenly it blossoms. One of my most favorite ones, which I saw very little action on, then started seeing some action, was the EX potato contract, which was brilliant technically. It was absolutely wonderful. And the EX butter contract, that had a very long-term action on it, which worked perfectly. About 2 months ago, a very long-term downtrend had turned around and broken out of a pattern. So it works well on those. And it works on illiquid or liquid markets. But as long as the data is clear and clean, you may just have initially just an open and close and high and low at one point. But as long as it's valid, then that matters, and that then can be translated into future patterns or future information. All of it works. It does actually work in all of those. I was trying to think of something even less liquid than those ones, but I'm sure there are ones. I mean, I've looked at the Handymax index because on the Baltic, because it's an index of shipping for the handy size ships, the ones that are used for virtually every port. And that's literally just a point, but it works beautifully technically. There was a fantastic pattern a few months ago when the market turned around, and you could see it in the way it was turning around, where it was going to go, what a potential area on the upside resistance was, where the support was. It was working very, very well.
Ah, that's good. Yeah. Okay, Clive, how do you feel about that, the liquidity issue?
I would say from a completely practical point of view that if you have low liquidity markets, it's obviously more difficult to analyze, to get too much analysis from shorter term time frames. And so for me, it's very much about time frames. And if you have markets with lower liquidity, then you've probably got to lengthen your time frame in order to be able to do a decent analysis of the markets. I was asked a few years ago to write analysis on coal, on the Rotterdam coal, which isn't a very liquid market. And then the last two or three weeks has gapped up, gapped down, gapped up, gapped down every single day. And it's been, I've been looking at this chart and going, this is horrible. What do I do with this? But if you look at the weekly, things become a little bit more obvious what's going on and where we're at. So that would be my simple answer to that is you've got to adjust. If low liquidity requires an adjustment, a lengthening of time frames.
I would agree with that, because the one I use for that is white sugar premium between the raws and the whites. There's two different markets in two different parts of the world. The origin of the whites is from the beet, the origin of the raws is from the cane, and there's a premium spread, and I track that, and it's best on weeklies on that one.
It work really sweet. Does it work really sweetly on the weekly?
I have to ban your jokes.
How long did it take?
Sorry, I'll make that the last one.
If I can make a contribution here about the liquidity issue, I teach technical analysis institutionally, and this comes up a lot, and I answer the question a little bit differently. What you said is absolutely true, that illiquid things, say with daily closes, if you produce a weekly chart of it, you'll have a candle there with an open, a high and a low and a close, and you can analyze it just like anything else. So the longer time frames kind of solves the issue, but of course it means you can't do it in the shorter time frame. But additionally, I would add a couple of things which would exclude things working well. The first thing is anything which is extremely low price. You can't form a head and shoulders in something which is trading at 2 cents or something like that. Something which is not freely trading, and that's what causes the market to go up or down. Everybody's a seller, or there's one big seller and then it just goes down because that one person is the seller. So it's difficult to put a number on it. The last thing about the liquidity is that really liquidity is another way of saying the size of the crowd. And technical analysis, in my opinion, works best when the crowd is large. Therefore, it behaves like a crowd. You have speculators, you have emotions, you have fear, you have greed, and lots of it. And therefore, you'll get head and shoulders, and you'll get these sort of psychological patterns, chart patterns formed. And the less you have that, smaller the crowd, the less emotional it is, and less, if you like, the foundation of technical analysis works. But sorry, that's my added comment on that. But we're getting some really good questions. So I think I'll go to the next one that I have here. No, so let's go through these questions now. They're really good questions. So do you think, or can you think of occasions where machine learning or algorithmic trading or AI has helped in commodity markets? And the questioner, Kishan, says especially in export trading, but let's just say generally in commodities. Do you see a benefit as a technical analyst, actually, of these things, of this type of machine learning and AI and algo trading? So let's start with you, Clive.
You probably got the wrong person for that, because Eddie is the agricultural markets man. But one observation that I probably would make about that is that algorithmic trading in general, is probably, when people say that algorithmic trading makes up 50% of the volume in the market, I think people sort of miss the point that quite a lot of it is just either nicking ticks or making markets. It can be very, very micro, and it doesn't. A lot of algos are set up to just do arb trades almost, and not to put on big swinging positions. Okay, so that does in itself create liquidity, and what it actually does is, there's my picture of the futures floor in London. You can't see it because of the reflection of the window, but on the futures floors back in the 1990s, we had these people called locals who provided liquidity to the markets, who were given a cheap seat at the table or in the pits to be able to provide liquidity to be on the bid and offer the whole time. So your bigger orders could get filled quicker, and that's, for me, you know, Algo is much derided, as far as I'm concerned, as being an evil thing. Computers taking over from humans and you know, and causing big moves in the market. My experience is that's not really what Algo does in the main. Algo is doing what the locals used to do. It's providing liquidity, which is a good thing for the market.
Eddie, thank you. Eddie?
I echo what Clive says on that, that it's basically an arbitrage engine to try and have a non-position play in markets, to take advantage of minute time or price discrepancies between markets, or time discrepancies in orders coming to a market. With machine learning and with AI, there's a lot. I mean, I cover so many more markets than when I first started. I mean, when we first all started, I mean, I don't know about you, but I started, it was still paper charts. We had a big scroll of point and figure charts for copper, platinum, silver, gold, and we used to update it literally by hand.
I'm not that old.
I am. And now the amount of markets, I could never do that then. So the benefit of modern technology has been to be able to allow me to look at much more markets. Now, can I teach a machine to be able to do what I do? Probably in time, but the work that's necessary to do that is not there yet, and still isn't. I can teach it to do a certain amount of things, to look for certain types of patterns. I can pre-program it, and then I'll have to go through it and say if what it's found is true or not, or helpful. It still relies on experience and knowledge to be able to make that final say that, okay, you may say this is this, but that's not actually helping you. The point behind it is in commodity markets at the moment, there is no conflict between the algo trading and technical analysis at the moment. There is no conflict between machine learning and AI and technical analysis, because it isn't up to speed at the moment. It can't do it properly. Now, whether that will change in the next 10, 15, 20 years, I don't know. But the knowledge that I have and the ability that I have to interpret a market is learned through experience. It's the old story of a guy who was an old guy who was let go from a shipyard, and then they couldn't get the ship going or whatever, and then they said, well, we'll get old Joe, he used to be there. He goes over and he looks around the ship, and he gets a hammer and smacks the side of the ship in one particular point, and the whole thing starts working. And then he puts his bill in, and it says $20,000. What are you talking about, $20,000? Well, can you break it down? Okay, yeah. $5 for the hammer, $19,995 for the knowledge of where to hit the hammer.
Yeah, exactly. That's great. It's a good point. I would just to add to the answer to your question, so broadening it outside the energy and agricultural commodity markets. You know, I also got experience in foreign exchange and equities, fund management, portfolio management, asset allocation, those sort of areas where actually AI is used extensively in the analysis process. But not so in, I would agree with you, in these markets. And I've wondered myself, why is that the case? But it's a lot to do with the data. The data that we're looking at is not structured data. We're looking at weather and things like that. It's non-compatible data. You get data from different countries. Whereas in other markets, say like equities, you've got standardized accounts and so forth. And so it's much easier for a machine to just go to that data and look at it. Same in risk analysis, and to look for anomalies or for insider trading patterns and things like that, because you're working with structured data. But we're still in a world of unstructured data, relatively inefficient, I suppose, in a way, but that's the nature of the market. And therefore, basically, as we can be presented in more and more efficient ways, the data, and in clearer ways, and we see all the information, the analytical information, in clearer and clearer ways using machines. But still, at this stage in these markets, human beings are the best ways of collating that and weighing it up and explaining it to other people. So if I may add my bit, I think there is a future for us, and it's actually probably longer than people would think, because it's really quite difficult to do what we do by machines, where in other areas of finance, it's just a process which a machine can do faster than any of us.
I agree with that. I agree with that.
Yeah. Okay. So that's how we're doing for time. We're doing fine. We've really answered. I'm just going through this question. Anuja asked, what is the future of technical analysis if we consider the advent of AI and machine learning? But I think we've answered that, haven't we? Yeah. That basically that it has got a future. And actually, AI and machine learning, do you think it could ever actually be better than a human being at forecasting the price?
I'll take that one if you want.
Yes, please.
I think it will help a human being because let's take a situation we've had in foreign exchange markets with the big flash crashes we've seen in sterling, I remember, overnight. In the old days when there were people at the desks, when a market started tumbling down, it would be stopped by the traders and they would ring up the Bank of England even at 11 o'clock or 12 o'clock at night and say, what's going, there's something going on here. What do you want to do? Oh, support it, don't let it go. We'll want to stabilize market. And that's what would have happened. In the current markets where there's no oversight of that and the machines are working much more faster, you saw a massive flash crash, taking out a lot of individuals, stops and causing panic to a certain degree, and then a move back up again. That flash crash, I had actually seen some pattern beforehand, and I've got a video proving it. I saw a pattern beforehand which said, this is how it will drop. And I actually said, look, I'm looking for 3 months from now because there's no way you can, and it happened to happen a week later. What we've got with machine learning and AI is another tool that will help us. It will take out a lot of the drudgery of things that we don't need to look at, that we can have somebody look at it and say, okay, this pattern is here. And then you need somebody to oversight it and see it. Same question you need to ask yourself is this: would you have a machine or a machine learning or an AI machine overseeing a nuclear power plant?
Yeah. No.
Would you?
Or flying your airliner.
Or your airliner, or your train service, or your water or electricity. Would you have it? Would you not have some sort of human element that could actually do it? Or, even as in the case of one bank, when a machine went slightly potty, the compliance officer had to go over and pull the plug out of the wall to stop it working. We're not into the state. AI is not into the state at the moment to be able to do it. Machine learning is, but it's a tool to be used. It's not a thing that replaces what we've got already.
Yes. Clive?
Yeah, I mean, most of my clients, for example, if I've got a client who's got a gas desk, then there's generally, I've been to visit a few of them, generally somewhere on the end of the desk is a meteorologist. And so and that's one of the inputs that and there's someone keeping an eye on where tankers are going. There's some excellent software and things out there for that kind of thing. And so you've got so many different inputs into, and they all have a morning meeting. I'm telling the audience what they do here. But the point I'm trying to make is that everyone I've come across has a jigsaw of inputs that gets put together, and fortunately, what I stick out seems to be part of the jigsaw for a lot of people now. I say fortunately for me, so technical analysis is one of the pieces of that jigsaw, and I think AI, machine learning, and algos that people will and are developing will be another input as well. And so or something else that were away but never be the running the main book. But if the machine sticks on a trade that looks like it's in line with the book or the view from the meteorologist and the technical analyst and then maybe that's when people are alerted to up their size or something like that. So it's just another input is the way I see it, and the way I see it being used, and the way I see that it will be used going forward.
Yeah, that's also my experience too. I contribute to one of those meetings each morning, about 30 traders on the call, and then fundamental and weather people. This is a power, gas, energy company, European, and I make my bit. But you know what the reason I'm there is because they know that you know, all supply, demand, stock levels, weather they are formulas, they're algorithmic. There's a huge amount of intelligent people involved in analyzing the weather and the implications for gas and power prices. But what they do know is that isn't always the price. And the technical analysts seem to be able to answer the question as to why things suddenly decide to shoot out and gap higher and things like that predictably at a certain level. And they cannot deliver any of that sort. And that's why I'm there, you're there, all of us are there, is because we do contribute, add value to the analysis process. And I'm sorry to another point that you made, Eddie, which I'd like to expand on a bit, was about in the sell side of say foreign exchange market, and that is all done by machines. There aren't any people there, and because it would be impossible to actually quote in nanoseconds doing a pre-trade credit check. These are OTC contracts. That has to be done in a split second, whether they can accept that or what size they can offer, and that's just not possible for a human being to do that. I'm talking about the sell side of the major currencies. But it's interesting, I do know that after the flash crash experience on sterling, that Christmas one, there was a Bank of England investigation about it. And one of the things that was that all the machines which did all this, they were actually very stupid. They set off stops, which set off stops, which set off stops.
Yeah, cascade.
And it escalated, cascaded. Now, the response to that was also stupid, because what they built into the programs then was, if the volatility increases by a certain amount, then stop quoting. So they ceased to do their function, which caused the next flash crash about 6 months later, again in sterling, and over a weekend, and basically, you know, they're called intelligence, but you know, they're only as good as the people that program them. And so one of the people that I know who's in charge of one of the very large sell-side dealing rooms, foreign exchange dealing rooms, told me that they were bringing back people into the dealing room because a human being would have seen that and would have known what to do. And he likened it to this analogy we were using just a moment ago with the pilot of a sophisticated airplane, which is actually a flying computer. It can land in fog and everything like that, but you still need to have a human being there to take over and to see things that are not right and take over at that very point. And we're a long way away from the day when hundreds of people will fly in a plane without a person in it. Okay, so we've got, I'm conscious of the time. So I think we're coming to the conclusion that technical analysis is a support tool. We're using more and more machine to help us do that, but still, particularly in this world that we operate in the commodities and energy world, where we've got a lot of unstructured data, it has to be interpreted. And you know, even in the areas where you've got structured data, it also has to be interpreted. Where, say, a risk analysis, and the machine says, "Oh, here's some unusual risk," but then a person will look at it and they'll say, "Oh, I can see why that is," or so forth. In the end, it was the machine that pointed out to them, and we are increasingly, all of us, using more and more aids to our analysis. So just coming then with the last minutes that we've got.
Can I just add something else on that? There is a pressure in some of, well, it's come from the financial markets, from the banks and from the various people involved in some of the financial markets, and it's now moving over into our areas to try and put that into something like a machine learning environment. Can we not commoditize this and make it standard because of what you're doing, because we can then save the costs or whatever, or plus technical analysis may not necessarily, like Clive is not available 24 hours, neither am I, neither are you. We have to have a sleeper every so often and things like that. So, and holidays and things. So there is pressure to try and put that into that, coming from the accounting side of the business, if you want. But those who are enlightened will realize the added value that technical analysis provides to any institution when they can actually bring them and say, okay, if you're a sell side, you say, here we have our economist, here we have our technical analyst, here we have our weather guy, shall we say, some meteorologist. All of them can then provide their clients a spectrum of view and provide an insight into what is going on in any market. And then you can also go into, say, the financials. So it all comes down to, yes, there's pressure to move towards that. But anybody who's enlightened will understand, will say, no, that doesn't help us in what we're trying to do. Yes,
absolutely right. And Clive, any comment on that?
No. Eddie,
you know,
Eddie's got it. Eddie's got it nailed. You don't need anything from me.
You know, well, I'll chip in then. One of the things is, you know, from my experience outside this world, where let's say the use of these machines is more developed, is whether the usefulness is really appreciated. So if you take, for example, equities, if you want an equity research report written on a stock, assuming it's a big enough stock, you go to your Bloomberg, you press a button, and it will write you a 20-page report, which used to take a whole floor of people, research analysts, with their Excel sheets to produce. Now it comes out, but it only just gives you a score at the end, you know, of how it compares to its peers and so forth. It doesn't really give you any ideas or any thoughts. And a lot of our job is really to point things out, opportunities out to people and interpret the information. But the machine is no good at that. It can assemble the information. It can present it in a nice, clear way, like a score, for example. But basically, people, customers respond to, they want say, well, you know, I review this and all that information, and I think this and the experience, and they appreciate our experience and our knowledge. Oh, sorry, Clive, yes, please.
And me.
Yeah. No, me first.
Stop talking, Trevor.
All right.
Well, no, I mean, what you've both been talking about there is resonates with something that's happened to me just today. Actually, I've spotted a descending triangle on the carbon daily chart and stuck out something today to say we've got a buy signal yesterday, and off we go again. And I had 2 or 3 clients email me and say, well, hang on a minute, isn't a descending triangle, you know, and they've got their very fixed ideas from textbooks, which is fair enough and is exactly how it's taught. They've got their fixed ideas of where where this pattern should be and what it should do for you. But actually, you know, and I actually, when I first saw these emails, I thought, oh dear, have I sodded this up? I checked on. You still hear me?
Yeah, my one's over there.
Right. Okay. So yeah, we've all got a copy of our Encyclopedia of Chart Patterns. Yes. It's not as good as Candlestick Charts by Clive Lambert, but shameless.
Available good and not so good bookshops.
Shameless. But no, it's in there that a descending triangle can be a continuation pattern and can give you a buy signal in a rising market, which is what this one's done. So I've got to now, after I've got off this, write a bit more about that to sort of, because I've had fair few questions, and that I think that illustrates the point that you guys have just been making, that, you know, there's different interpretations, there's different things that and you know, and so there might be people scratching their head today looking at carbon going, well, what was that move all about this morning? Why is it suddenly shot higher? What's the fundamentals behind that? And my argument would be, maybe it's nothing to do with fundamentals, it's the chart. The chart's giving us a buy signal. Boom.
Right. Clive, don't say the F word. This is a family audience.
I didn't swear.
You said the fundamentals.
Oh,
you shouldn't say that stuff.
Sorry,
all right?
yeah,
I don't want to hear that.
Sorry,
our audience don't want to be involved in that.
I'm sorry. Yeah.
All right. So you know, consider yourself yellow carded on that one.
Okay.
The thing is, people want simple solutions to what are complex problems. I had LME copper I was talking about a few weeks ago, and there was a key reversal down on it. And I said, you can have that as a simple answer to what's happened. It was a weekly key reversal, I think it was. And I said, you can have that as a simple solution to what it is. But what it does, what I say is this shows a level of indecision, because the prior week, I think it was a key reversal up followed by a weekly key reversal down. That just means indecision. That means the market is not sure, but not on an intraday level, but on an intraday level or interweek level. It wasn't sure what was going on. And lo and behold, it didn't actually work through that particular time first off. And then some various things happened, and we started sort of dripping a little bit and then started moving back up again. So the natural desire is for the everybody to get a simple solution, a yes, no, and not all of it is available at that time. I mean, one of the questions we have about what happens in sideways markets, well, look at options for crying out loud. You know, if it's going sideways, you use that market instead for accessing opportunities in a particular thing. If it's going sideways, those, if you're trading within a range and you know what the range is, and if you know within, say, for example, a pitchfork, which is what I use, you know it's going to go. That's the angle of attack. That's the way the market's moving. You know where the resistance is. You know where the support is. And it's moving up every day or moving down every day. It's not rocket science.
Yeah, exactly.
Sorry for my little off going there.
No. That's, yeah, you're absolutely right. Both right. That's great.
You got a bit ranty.
I've got an interesting question. Sorry?
Eddie got a bit ranty there, didn't he?
Yeah.
I'll shut up now.
I've got a good question here. I'd like to get you to answer, both of you, before we come towards the end of it. You know, which what would you like artificial intelligence to be able to do to help you as a technical analyst in your work process? Let's start. Well, let Eddie relax for a second, and Clive.
Okay, well, as a one-man show, I wouldn't mind a machine that can make a coffee or tea for me.
Oh yeah.
But that's not really answering the question.
I got one. This is Neil.
I'm not completely sure. I think I'd like to dial down into to volume at price data better than what I've got in front of me, particularly with respect to contracts that roll, because my particular charting system right now doesn't deal with that very well. So I'd like better information on volume at price, which is one of the inputs that I really like, and I don't think I get that right now.
Yeah.
And it's difficult to then, you know, do the analysis as well as I'd like to on that side of things.
That's interesting. Of course, volume at price analysis is very, very data intensive, and therefore great for computers to do. Particularly you want to go deeper than the market profile and go through time.
Well, you've been involved in a product on that, haven't you, Trevor?
Yeah, but it's very data intensive, and you know, well, we have trouble really because of actually the quantity of data.
Yeah, so there you go. I mean, you know, if we were at one of the, you know, big banks or institutions or trading houses, we might have some bigger computers available to us, but no one's ever offered me that job. I think
Eddie, anything
I'd be too much trouble.
There are a number of 2-day patterns, 3-day patterns on candlesticks, which I would love to be written into a program that could just sift through all the charts I look at, and a lot of the ones I don't look at, and come up with a list and say, this is fulfilled your criteria. And then I can look at it and say, okay, that's true or not. So the ability to do we all have manual tasks we look at. We all look at each chart every day. I look at the euro, I look at sterling, I look at Indian rupee, look at Brazilian real, I look at Mexican peso every day, copper, aluminium, all these things. I just want something to keep an eye the way I do on those, which I'm happy to do, on some of the other markets that will just flash up and say, this is one of your criteria is fulfilled, and that can do that. Now, the coding and stuff, I've been speaking to people to do that, but the problem is that we speak 2 languages. I speak English and they speak something else, and I can't get them to actually write what it is I wanted them to do, and they haven't been able to do it. And it's not ADM, it's outside of ADM, the providers. They're just not able to do that for me at the moment. So that would make life easier and be able to open my mind to be able to even look at more markets than I already do, which would be one of the things that I would help.
When I was global head of technical analysis at Bloomberg for a number of years, and one of the things I had to do was be the interface between the users, the traders, and the programmers, and so designing the user interface in the charting part of it. And I learned a lot there about how to talk to programmers. They only think in binary, but if you want to describe the RSI and interpreting the RSI for you and I, we can say it to each other and we can understand it, but it's actually extremely complicated. But the answer is, I realized, if you write it down very, very specifically, they can program it up really, really fast. And that has held me in good stead since that time. It's now a long time ago in, in the fund management world that I'm in now, and system development world, it's really specifying these things very clearly, which is not natural for us because it's sort of obvious to us in our heads, but writing it down in a way that these people then can program it up very, very, very quickly for you. So that's basically something that we have to learn in order to make the most of these machines, because we know what we want and we know it's good, but it's a bit question of describing it.
Maybe you should have a machine that can actually interpret what we're trying to say and then program it rather than somebody as an interface in between.
Yes,
that could be too far,
yeah.
I think.
Well, it's getting like that. I would say there's a longer program itself is becoming more self done by the machine itself rather than the human being the way it used to be. Okay, let me just ask you, right, we've got a couple of minutes left. Clive wants to show us something, so.
Well, I've seen one of the questions.
Yes, I was going to say, go ahead.
What are the best technical analyst courses available and which institute to opt for? There is my
Society of Technical Analysts.
Technical Analyst diploma. Eddie's pointing at his. Trevor's got his somewhere, but
mine is over there.
He's over there. Right. So that's how we all know each other, or mostly. I've put the link in the chat box for the courses, for the STA's courses, and well, obviously, I'm definitely going to say that's the best course because I teach on it. I do a couple of the evenings for the yearly diploma course, but there is also an excellent online off-the-shelf software
home study course.
Provide a home study course, and yeah, I don't think you can see past that with respect to education on technical analysis. But I would say, and I'm then going to let other people have their say about this, this is a course that teaches you technical analysis. It doesn't teach you how to trade. Technical analysis is one of the inputs into trading, and it's an absolutely, for me, the best course on technical analysis. But you won't necessarily become the world's best trader if you learn about technical analysis. There's more to it.
Yeah,
I think we all agree with that. It's the best course around, been around for the longest, tried and tested. It's qualification, professional qualification, valuable qualification that is recognized the world over. Modesty stops me mentioning that I also run courses, but they're only specifically.
Please continue, please.
For companies and dealing desks, and they're very much tailored to the work process of the people themselves. But the STA course is really the best that's available out there as a general course. Okay, so we've got 1 minute left. Would you like both of you in 30 seconds each give me your tip, if you like, technical signal that you caught this morning or something like that that you'd like to share with the world? So starting with Clive, would you like to go first?
I've said it already. I've said it already. We've got a bias signal in EUA carbon descending triangle, triggered with yesterday's strong close. Yesterday was a bit of an average, sort of not a particularly strong close, but it was above 51.08, and that's what's given us the buy signal. And we've made a good start with that, with a strong day so far today.
Eddie, sorry, I have to press you there. We've got seconds.
There's two Andrews pitchforks on soybean oil, Chicago soybean oil. One from January through to April, or sorry, late March. One from late March through to May. They're showing the bullish angle of attack. You can see the middle time on the second one is literally just following along the underside of it. It's absolutely brilliant.
Have a look at that.
Okay, that's great. Thanks, guys. I'll add one. Dutch Power, TTF, front month, ascending triangle, a classic, one for your album. there. And thanks very much, guys. Very, very much. I enjoyed that. I hope everybody else has enjoyed it too.
Meet us later on at the after this. We're all at the other thing, aren't we?
That's right. So I was going to say, stay on for the discussion, which follows on from us now in 2 seconds. So thanks very much, Eddie. Thank you very much, Clive. Wonderful to talk to you again. And I hope everybody else has benefited as much as we have.
Cheers, guys. It's been a pleasure.
Thank you.
Brilliant. Thank you very much indeed.
Okay, bye-bye.